Action.
So today we are actually, I'm still flashing you this. Be a nice person, okay? Buy for someone, okay? And funny enough, if you actually buy for someone, that by sponsoring, you can determine or decide where you want the copies to go. So it's really your take, okay? So you tell us where you want the copies to go. We take it there for you, depending on the state that we are distributing at the moment, or at whatever point in time that you sponsored. Okay, so here today we are looking at a question that will also give us an insight into accounting for payroll. Okay, so if you hear payroll, okay, you should be able to tell what we're talking about. So when you hear accounting for what? Payroll. Now, all through my field experience, I had various names or various terms expressing the same thing. I had things like what they call personnel costs and benefits. I heard what they call employee costs and what? Benefits. Okay, I even had payroll costs. Okay, payroll what? Cost. But basically, what they are trying to tell us here is the cost of human capital. Some organizations use human capital. Human capital represents the total workforce utilized to, improve productivity by an organization or a business. So you hear human capital department, you hear human resource department, and all that. So typically, payroll, personnel cost and benefits, employee cost and benefits, or payroll cost, is typically a function of human capital management or human capital development, okay, or human capital. So the idea here is that, while there is the accounting aspect of, the cost involved in what bringing in people or expertise or individuals to work for an organization, okay, the human resource department is typically responsible, okay, for the policies that involves selection and what getting the right personnel for a particular position in an organization. But at the end of the period, which is usually the month, okay, where payment is to be made, usually the computation starts from the human resource department, then flows, okay, maybe to the internal control unit, then flows to the accounts unit, okay, after vetting and all that. But depending on the process or procedures put in place by an organization, eventually the payroll gets to the accounts department. Then as an accountant or the person in charge of accounts, you must understand, okay, some aspects of payroll, or what they call personnel cost and benefits, or employee cost and benefits, or payroll cost. You must understand some technicalities involved in accounting for payroll. So basically, to help us with some background, you must understand that the employees or the personnel of an organization can either be insourced, okay, or outsourced, okay. So if it is outsourced, what we're saying here is that you are trying to operate the lean structure where you get someone to bother themselves about the staff that you need to do a particular thing, or that you need to carry out various functions, and you pay that person. So it's like you're contracting, okay, the human capital or the human resource to another company. So what I'm saying is, let's say company A, okay, has a business. Instead of, recruiting HR or getting HR to now help him with the various procedures of bringing in an individual or bringing in workers or bringing in laborers or bringing in, staff or employees into the business, he gets another company, let's say company B. Company B does everything, gets the people that will do the work, okay, then assign the employees, okay, on the request of company A to various fields where they want them to work. So at the end of the month, company B sends an invoice to company A, okay, then company A settles company B for that job. Okay, but here under the in-source, so here now what we've explained here is for outsource. Now for in-source, what we're saying is that the company gets an individual, usually the HR, okay, to take up the responsibility of employing staff, okay, or workers when required by the organization. So what I'm saying is that, so instead of company A giving the job to company B, company A gets someone called the HR, okay, or human capital head, okay, to be responsible for getting every employees, okay, required to work for the organization. So at the end of the month or at the end of a particular period, depending on the policy, okay, this HR computes the cost of all these employees, okay, and then sends to the accountant for payment. So in doing this, it is expected that as an accountant, you must understand some aspect of the payroll. For instance, you must know the tax aspect of the payroll. Okay, so you must understand that taxes called pay as you earn are paid to the respective state internal revenue service. So if your employees are resided in Lagos, for instance, you expect them to pay their taxes to Lagos State Internal Revenue Service. So what I'm saying is that your employees are taxed, okay, and then the tax is deducted from their salaries or wages, and then remitted to Lagos State Internal Revenue Service. So what I'm also saying here is that you must understand that the pay as you earn, okay, is linked to where? To the Personal Income Tax Act. Okay, that's amendment in 2011. Okay, so now the Personal Income Tax Act helps us understand, okay, how to compute the payroll of employees to get the fair or the most reasonable tax deduction from the employee's salary at a particular point in time. Now you must understand as an accountant that employees that reside in the Federal Capital Territory, they remit towards the Federal Inland Revenue Service. So that means if you're living in Abuja, okay, taking Nigeria as a case study here, okay, you are to remit your so if your organization is in Abuja and your staff is in Abuja, or even if your organization is in anywhere in the state, but your staff they reside in Abuja, it's expected that you remit their tax deductions to the Federal Revenue Service. There's something called what we call highly mobile employees, usually federal government workers, highly mobile employees. Okay, that means they hardly stay at the point. So those sort of employees, you also remit to the Federal Inland Revenue Service. Okay, now there's something also called non-resident employees. Now, non-resident employees are employees that are not resident. They don't reside in a particular country, but they are earning from that country. So you can be, let's say, a Togolese, for instance, and then you are earning in Nigeria. So you are non-resident employee. Okay, there's something called expatriate as well. In fact, we have Nigerians too. You can be a Nigerian, but you're not living in Nigeria, but you're earning in what? In Nigeria. So we have expatriate. Expatriate are like specialists for a particular what? Job. So usually what happened? Okay, you bring them into the particular work. Okay, so long as they are earning here in Nigeria, they're expected to what? Pay their what? Income tax here in Nigeria. Okay, so you must also understand that Peter, that's Personal Income Tax Act, tries to give an explanation. The amended part of it try to give an explanation on what we call temporal staffs and what permanent what staffs. Temporal staffs are usually referred to as contract staffs. Okay, and then permanent staffs are those staff that are in the employment of the what organization. So, but there's been an argument as regarding if contract staffs are to remit and pay as you earn or not. Now, the issue of permanent staff has been resolved. They are to remit pay as you earn. But Peter defined, or try to clarify that by saying that what employees either in the temporal employment or in the permanent employment are expected to what remit their pay as what you earn. So what we're trying to say is that what the clarification on whether contract staff should pay salary, should pay tax or not has been what resolved by the Peter amendment. So what we're trying to say is that whether you're a temporal staff or a permanent staff, you're expected to what pay your income tax. Okay, now so you must understand that there's something called direct assessment. Now direct assessment is a little bit different from from what we call pay as you earn, but it's still the same income tax. So direct assessment here is for self-employed individuals. So if I have my own business as a self-employed individual, so it means that whatever I make from my business is more like an income to me. Okay, so we expect that I should submit myself to direct assessment by the respective revenue service. Okay, depending on my principal place of residence. Okay, so that I'll be assessed, and then we get a fair tax that I have to pay to the revenue service. So basically, it's either you employ someone, deduct from their income or their salary, remit, or you yourself submit yourself for an assessment to know what is taxable from the income that you have made within a particular period. So that is it with the salary income and direct assessment. Now you must understand that there's something called pension. Pension. Now what we are saying here is that employees are expected to contribute on a monthly basis to what they call retirement savings accounts. Okay, now the retirement savings account, the Pension Act actually tries to tell us to deduct 8% of gross income of employees. So what I'm saying is that if an employee is earning say 1 million per annum, that employee is expected to contribute 8% of that 1 million to a retirement savings account. Of course, he has the right to choose whichever administrator that he wants. So you can decide to choose the likes of maybe Stanbic IBTC, maybe Legal Pension. So depending on whichever one you want, so there are procedures in place to get that amount remitted to the expected administrator. So basically, you're going to contribute 8% of your gross income as an employee. Then your employer will contribute 10% of your gross income. So now in computing the income tax, now Peter defined income of an employee as whatever has been earned as a result of working in an employment. So we can say your salary, we can say your allowances, we can say your bonuses. Okay, so whatever you earn, okay, as a worker, as an employee of an organization, okay, what we call remunerations. We're not saying maybe you were sent on an errand and then they paid for your transport or you paid for your travel. No, what is the fixed amount of remuneration agreed as an employee of that organization? So it includes bonuses, allowances, your basic salaries and all that. So they are all your income and they are taxable. Okay, now the idea is that while trying to compute the income tax, there's something called Consolidated Relief Allowance. Now what we're saying is that, usually before the amendment, we had, basic salaries, we had allowances and all that. But the amendment actually, brought everything down to what? The gross income, what we call the gross emolument. Okay? So your gross emolument now is what the function of your basic salaries and whatever allowance that has been fixed in your appointment letter. Okay, so if you have, say, a base salary of, say, 1 million, and then you have transport allowance, qualification allowance, all those allowances, okay, they all form part of your gross emolument, as long as it is a fixed amount that has been agreed for payment. So they all form part of your gross emolument. So when you add everything together, or when you add everything up, 8% of it is contributed to what? To your pension scheme by you as an employee. Then the employer will contribute 10%. Okay, although in some instance, you can, if you're a good negotiator, you can negotiate with the employer to bear all the cost of the pension. But then, aside that, there are other schemes, like maybe housing fund schemes, health schemes, insurance schemes. If you're contributing to these schemes, okay, they reduce your liability. What I'm saying is that if you are earning 1 million and you're contributing to what? Pension, contributing to insurance scheme, contributing to health scheme, okay, maybe life. I think insurance is life or health insurance, okay, or maybe fund, a housing fund. You're contributing to that from this 1 million, okay. You are expected to what? To be allowed those contributions before they apply their tax rate. Now, the Consolidated Relief Allowance here, okay, is saying that your gross emolument or your gross income, before you subject it to tax, must, have a relief of some amount. That means you must take out some amount from it before you subject it to tax. So what we're saying is that you're going to have to say, okay, your gross income, we have 200,000 naira, okay? You compare it to 1% of your gross income, okay? So whatever it is, if 1%, now 1% of 1 million is how much? That's about, so we have 1 million times 1 over what? 100. So that would be what? What am I seeing here? I'm seeing 10,000. So if 1% of 1 million is giving you 10,000, and then you're now comparing it to 200,000, which one is higher? You pick the higher one, which is 200,000, plus 20% of the gross income. So gross income is 1 million. So 20% of this 1 million. Okay, so do 1 million times 20 over 100. What do you have? 1 million times 20 over 100. So we have this, cancel this, cancel this. I think I can see, that's 100,000, right? 100,000 times 2, that's 200 what? 1,000. So you now say 200,000 plus 200,000, that's what? 400 what? 1,000. So this 400,000 now, you take it out of this what? 1 million. That remaining how much now? 600 what? 1,000. This 200,000 naira now is what is subject to what? To income what? Tax. So what we're not saying is that aside from the Consolidated Relief Allowance, you can have contributions that you make to what? To your pension. Okay? You have contributions that you make to your what? To your pension. Make contributions to pension. So make contributions to what? To pension. can make contribution to what? Your health insurance schemes or life insurance schemes or housing what fund. So if you're making contribution to all this, whatever contribution you're making, we also reduce this. So if at the end you made a contribution of, let's say, for sake of argument, let's say 50,000, okay? So that means that you further reduce this one by what? By 50,000. That will be what? You now have 550,000. This is what you are now going to subject to what? Income tax. Now, in subjecting it to income tax, there's what we call the what? The schedule of deduction. Call it the 6th schedule of deduction. So the schedule of deduction, okay, that's after taking out, the CRA, that's the Consolidated Relief Allowance, and then whatever contribution you made out of your income. Okay, when we take those out, we get a taxable income. So the taxable income is now subjected to what? To the 6th schedule rates. Okay, or what we call the schedule of deduction or table of deduction. Okay, so what do we do? We break the income down into various what stages. So we say the first 300,000 we apply 7%. So after taking the 300,000 out, if the income remaining, okay, is still up to 300,000, we apply 11%. By the time we apply 300,000, if the one remaining is up to 500,000, okay, or it's less than 500,000 but over the second 100,000, so we say 500,000 at what? 15%. Then by the time we apply this, the next one, 500,000 again, will be at what? 19%. Now at this stage, whatever is left, around 1,600,000, we're going to apply 21%. Now, if whatever is left is around 3,200,000, we apply 24%. So the point I'm trying to make is that by the time, as an accountant, you related with your HR and then internal audit or internal control, if you have one, by the time you finish applying all those reliefs and then the taxable income, you apply this schedule, you'll be able to tell the tax that you're to remit to the Inland Revenue Service. Now remember, there are two scenarios. You can pay the salary immediately and remit immediately, or you pay salaries the following month and then remit the following month. So depending. So if you're paying salaries in this month or in the month of what? Of computation, it means you're what? Debiting what? Salaries and what? Wages with the what? With the gross amount of salaries or personnel cost or payroll cost. You're crediting what? Bank. You're paying through the bank. Abi? Remember, the gross amount, that's the amount that the employees are entitled to, right? But you have another tax, which they are not taking. They are taking net. So this money you're paying here now is the net of the what? Salary. So that means that you're still going to have to make provision for what? Pay as you earn, Abi? Or you can say revenue service or internal revenue service. That's the tax deducted. Then you also credit for what? You say pension administrator, Abi? For the pension derived from what? The salary. So that means this gross that I have debited here, okay, has the corresponding debit of the what? Pay as you earn, the corresponding debit of the what? Pension administrator, and the corresponding debit of the net amount that you have paid. That if you're paying salaries in the same month. Now, assuming, okay, that after paying, you also paid this one. That means you're going to what? When you pay your what? Your tax, what do? You debit what? Pay as you earn. Abi? Credit what? Bank. When you pay pension, debit pension administrators and credit what? Bank. That is where you're paying in the same what? Month. But what happens if you're paying the following month? If you're paying the following month, definitely you're debiting salaries and what? Wages. But you're not crediting back because you're not paying in that month. That means you're going to accrue for it, Abi? It means you're accruing for, so you're going to credit what? Accrued salaries and what? Wages. You are not paying. That's a liability. Then, what else? Of course, you're crediting what? Pay as you what? Earn. Of course, you're crediting what? Pension administrator. So, in the following period, when you now pay the salaries, what will you do? You're going to debit what? Accrued what? Salaries and wages. And what? Credit your bank. When you now pay your pay as you earn, what do? Debit pay as you earn or your Internal Revenue Service. And credit what? Bank. When you pay pension, debit pension administrators, and then you credit your what? Your bank. Now, remember that the employer, okay, so now what the employer has done, the employer also contributes 10%. Remember, the employee, okay, is 8%, employer is what? 10%. Now, the employee deduction, which is 8%, is already out of the what? Gross. But the employer is also paying 10%. So what would that mean? It will mean that the salaries and wages will increase by that 10% contribution. So what do? You debit what? Salaries and what? Wages. Okay? And what? Credit what? Pension. That's if you have not paid. But when you pay, what do? You credit bank and debit what? Pension what? Administrators. Okay? So this is just scenarios explaining when you pay the salaries in the same month and when you pay salaries the following what? Month. So after which you prepare your income statement, prepare it. As a matter of fact, some management, you know, I think I've explained that earlier. Okay, are always interested in the salaries. Okay, you know, salaries are fixed costs. You know, when they are trying to control cost or reduce cost, the first point of contact or where they want to hit is the salaries. You know, of course, we have rent as fixed cost as well. Okay, so they want to know how much they are spending in terms of labor costs. So they want to try and reduce it. You know, to help the business. So you should be able to prepare this sort of you know, reports to help management understand how much they are spending in terms of labor or in terms of what employee cost or personnel cost. Okay, and then of course you carry your HR along so they can manage that aspect of what human behavior and all that. Okay, so basically this is what it is about accounting for payrolls or employee costs. If you have questions, you can reach me on the number displayed. So quickly, let's take this question and then so we can have an understanding of how to prepare the payroll. And then, after we prepare an income statement and all that. So let's take this question. Now, from the following, you are required to prepare the payroll, extended trial balance, and income statement for Amiga Ventures Limited for the month of March 2019. Okay, so we have sales, cost of sales, total running and administrative expenses, owner's equity, liabilities, investment income, current assets, accumulated depreciation, non-current assets. Okay, and then we have additional information there. They say the personnel record showed employees categorized into two batches. We have each batch having a total of 10 employees. So we have batch A, employees are on a basic salary of 3 million naira per annum, each with allowance of 25% of basic. Batch B, employees are on basic salaries of 4 million naira per annum, each with allowance of 30% of basic. Then we have employees of the business only contribute to the pension scheme. So employees usually get paid the first week of the following month. So we have depreciation computed for the month amounted to what? 1,250,000. Okay, so this is I guess basically to help us understand how to prepare a payroll, okay, fairly to know a fair amount that we can actually charge for tax or compute for tax that is remitted to the Inland Revenue Service. But then you must understand that in order to make it a little bit more practical or more engaging, you can take a walk, visit the Inland Revenue Service of your state, ask questions. You can ask to see an officer that can give you answers to your questions. So with that, it's a lot more easier to understand computation from the past. Some revenue service even will give you a schedule, already prepared schedule telling you how much each category of what salary earners pay per month. So that makes it easy for you. So you don't have to do so much of computation if you want to work with their schedule. But then, even if you're working with their schedule or not, you should be able to understand how to prepare it. Okay, so you don't just be one of the OES members. So let's just proceed now. Okay. Let's proceed. Sponsor copies of my textbook so we can give students. So we have Mega Ventures Limited. Okay, so let's say payroll for the month of what? March 2019. Okay, so how do we go? Let's do it more like a statement. So you can do it in this Excel format, vertical format. You should learn how to use Excel. I already said that earlier. Learn how to use Excel. It makes it easier if you have to put those formulas and all that. Or you can even ask your management to invest in some payroll softwares. Okay, so that will help you do all this. But then, okay, like I said, if you don't, if you want to control cost, you can actually use your Excel, and then based on your understanding of the rules and procedures, you prepare the payroll on your own. Okay, so let's go now. What do we have there? We have 2 batches of employees. Okay, so let's say what now? Let's call this batch A and batch what? B. Okay, so we have basic. What's the basic salary there? Basic salary there we have for batch A we have 3 million each per annum. So, and there are 10 of them. So 10 people times 3 million. So that will give you what? 30 million, right? So we say A 30 million. B is 40 million per head. So times 10, that's 40 million. B is 40 million. So allowances there, we have batch A, we have 25% of basic. So allowance there we have 25% of basic for A. So if you do 0.25 times what? 30 million. What do we have? 0.25 times 30 million. That's 7,500,000. So we have 7,500,000. For batch B, they said what? 30% of basic. So we have 0.3 times 40, 1, 2, 3, 4, 5, 6. So what do we have there? We have, is it 12 million? Is it 12 million? Okay. Okay, so we have 0.3 times 40 million. So what am I seeing here? I'm seeing 1,200,000. No, this is 40 million. 40 is 12 million. So what do we have now? This is our gross emolument, or let's call it gross income. Okay, gross income or gross emolument. So this will be what? 37. This will be what? 52 million. All right. Now, what do you take out? You take out your what? Less your what? Consolidated relief what? Allowance. So what is it? What is this CRA now? CRA is what? 200,000 naira per person. Okay. Okay. Or what? 1% of what? Gross what? Emolument or gross income plus 20% of what? Gross what? Emolument. So when you compute 1% of gross income, compare it to 200,000, whichever is higher, you pick it and then add to what? This. So now, if you're doing for 10 people, that means this is going to be 2 million or 1% of what? Gross income plus 20% of what? Gross income or gross emolument. So what do you have here? If you do 1% of gross income here, okay, so 37,500,000 times 0.01. What about it? 375,000. So here we have 375,000 plus, so you know here it's 2 million. 20% of this. Okay. What do I have? 7,500,000. So we pick 2 million since it's higher than this. So 2 million plus this, that will be 9,500,000. 9,500,000. For this one now, it's the same thing, right? We already know that this is higher. So that will be 2 million plus what? 10% of this. Sorry, 20% of this. 0.2 times what? 52, 1, 2, 3, 4, 5, 6. 10,400,000. Okay? 10,400,000. So if you add, what do you have? 12. Is that not 12 million? Plus what? 2 million. 12,400,000. Okay? Now remember that this is consolidated relief allowance. Now they said what? Employees contribute to the pension scheme. So what's pension scheme? Pension scheme is what? Employee 8% of what? Gross emolument. Employer 10% of gross what? Emolument. But this is the employee, okay? So we also what? Pension contribution. So what depends on that will be 8% of gross here. So 0.08 times 37,500,000. 0.08 times what? 52 million. So what do we have? 0.08 times 37,500,000. What do I have here? 3 million. What about this? 0.08 times what? 52, 1, 2, 3, 4, 5, 6. 4,160,000. So you're taking this out. Okay? Let's try to space this. So if we say what? 37,500,000 minus what? 9,500,000 minus what? 3 million. What do we have? What am I seeing here? I am seeing 25 million. Let's try again. 37,500,000 minus what? 9,500,000 minus 3 million. I'm seeing 25 million. So this one now, we have 52 million minus 12,400,000 minus 4,160,000. So I'm having there 35,440,000. So this is what we call your taxable what? Income. So this is what we now apply. Excuse me. This is what we apply. What? The 6th schedule table now to. Okay. So remember, this is for one person. Okay. We have what now? 3 million for 10 people. Okay. So what will happen? Let's do it like this now. So tax to be paid now. Tax to be what? Paid. So we have what? Let's call this batch A, batch B. Okay? So we say first 300,000. Remember, this is 300 and this is for 10 people. 10 times 300, that's 3 million. So we take out the first. That's 3 million. 3 million. So on the first 3 million, what do you have? That will be 0.07. 7% times what? 300,000. 21,000 times 10 people. 210,000. So we have 210,000. 210,000. Right? Second, 300,000. So if you take this out, what do you have? This will be 22 million. What do you have? 000, 044. This will be 2. What do you have here? 3, right? Yeah. So that means you can still take the second 300,000 from this. So the second, here will be what? 3 million. You have 3 million again. So what second, you're still paying 210,000, right? Now, for the third, it has moved to 500,000 at 15%. Remember, there are 10 people, that's 5 million. So we say third 500,000. So that will be 5 million, right? This, let's get this way. This will be 21 million. This would be what? This will be 29,440, right? So the third, that will be 5 million. Right? So for the third, what do you have? 0.15. Right? So what do you have now? 15. No, the second 300 now is 11%. Okay, so 11%. Excuse me, please. My bad. So it's 11% times 300,000 times 300. Okay, that's at 3,000. Then times 10 people. 330. So this is 330,000. 330,000. Okay, sorry about that. So the next one now is 500,000 at what? 15%. So what do you have? 500,000 times what? 0.15. 75,000 times 10 people. 750,000. So we have 750,000 750 what? 1,000. Okay. So what's the fourth? The fourth is another 500,000, right? But now at 19%. So if we take this out, what do you have? 11 minus this, that's 16 million. This, 0, 0, 0. This is 4, right? 4, 1, right? 0, 0, 3 zeros. This is 0, 4, 4. 9 minus 4 is 4, right? This is 2. Now we have the fourth. The fourth what? 500,000. So we have 500,000. Sorry, 5 million rather. Maybe there are 10 people. 5 million. 5 million. So fourth 5 million. Fourth 5 million. Okay. So sorry, fourth yeah, 500,000 per head, right? So we have 0.19 times what? 500,000 and 5,000 times 10, 950,000. So we have 950,000, 950 what? 1,000. So if we take this off, I think you have 11 million. Is it 11? 16 million minus 16 million minus 5 million. 0, 0, 0, 3 zeros there. 16 minus 5. 16 minus 5 is 11 million, right? So we have 11 million. So here, what do you have here? Use a calculator. If you have 24, 440, 000. Okay, minus 5, 1, 2, 3, 4, 5, 6. You can see 19,440,000. Okay, so this is it for the fourth. So the fifth now will be what? 1.6, right? So for 10, that's 16 million. So it means that this will end here, but this will still continue. Okay? So this guy now is having 11 million naira left. So we just apply what? That's 21% now. 21% on the 11 million. So we'll say fifth. The fifth here, this one is remaining 11. So there's nothing left. It's not up to 16 million, okay? So this will go off. So we're going to say 21% of what? 11 million. So 0. What? 21 times 11, 1, 2, 3, 4, 5, 6. Okay, so what do you have? 2,310,000. 2,310,000. But this guy still has enough. He can still take 16 million, right? So that means you're going to have 0.21 times 16, 1, 2, 3, 4, 5, 6. Okay? That's 3,360,000. 3,360,000. So apparently, A has finished its income that is taxable, but this guy here is still remaining something. So 19,440, let's show that somewhere here. 19,440, okay, minus 16 million. So what do you have? 0,000,4,4. 9 minus 6, I think that's 3. So it's remaining 3,440,000. So for the 6th, on the 6th schedule, which is what? 3.2 and above. Okay, so we have 3. This guy does not have anything, but there's no money left. But this guy still have what? 3,440,000 left. So we just apply. So it's 0.24 times what? 3,440,000. What do you have? 825,600. We have 825,600. So this is the payroll, and then this is the tax to be what? Paid. Okay? And remember, it's per year. So that means if you add up everything, so annual tax based on the what? Based on the payroll will be 210,000 plus 330,000 plus 750,000 plus 950,000 plus 231,000. So this guy here is what? 4,550,000. So what's this guy's on now? 210,000 plus 330,000 plus 750,000 plus 950,000 plus 3,360,000 plus 825,600. You can see 6,425,600. So this is the annual tax. The monthly tax will be divided by 12. So divide this by 12. Divide this by what? 12. Divided by what? 12. So the 10 people here is paying 535,467 approximately. Then here we have 4,550,000 divided by what? 12. Here I can see 379,166. That's the monthly pay as you what? Earn. Okay. Now we've been able to compute the tax. So let's raise the journals. Let's raise the what? The journals. Okay, so that we can do the extended trial balance. So what do we do? Or we can simply just do the extended trial balance like that. But let's raise the journals. Where are the journals? So what they say? They said what? Look how they say there. Employees are only employees are get paid the first week of the following month. So basically, they don't pay them in the what? They don't pay them in the month of what salary. They pay them the following month. So what will happen? So we have debit, credit. So what happened? So we're going to say salaries and what? Wages. What salaries and wages? That will be the gross amount. What is the gross amount? Okay. The gross amount here is what? 37,500,000. Right? So we'll say what? Accrued salaries and what? Wages. No. Let's break it down. What is the net amount that will be paid to these guys? Let's combine it, Joe. Batch A, batch B, that's this plus this, right? Remember, we have this plus this, Abi. total salaries and what? Wages. That will be what? Ah, 37,500. Okay, 37,500,000, right? 37,500,000 plus what? 52 million. That's what? 8 million. What? 89,500,000, right? So we have 89,500,000. This is total salary and Abi, but you're going to less what you're going to pay to do what to the employees now. Of course, they are contributing what? Pension. So what's their pension? 7,160,000. So less pension contributed by the what? Employees, right? 7,160,000. We're going to less again the tax. What's the tax they are paying? They are paying this plus this, right? 4,550,000 plus 6,425,600, right? Tax there is 10,975,600. So we have 10,975,600. Okay, so this is their what? Salaries and wages. This is their what? Pension contribution. You're taking out of their salary. You're not paying them everything. You're taking this out to be given to what? Pension administrator. You're taking this out to be given to what? Inland Revenue Service. Remember, this is per annum, so you're going to convert to per month. So you're reporting per month. So if you take this out, so their net pay. Okay, of course they have any deduction, you deduct, but here there's no deduction. Maybe they have borrowed money, but it's not borrowed. So we have 89,500,000 minus 7,160,123 minus 10,975,600. So the net pay here is 71,364,400, right? That's the net pay per annum. So per month, we divide this by what? 12. Okay? So what do we have? So their net pay per month is what? 594,7033. That's is that 5,947,033. This is their net pay per month. So remember, I'm paying the account on monthly basis. So salaries and wages now per month. Per month, what salaries and wages per month? That will be this plus this divided by what? By 12. Okay? Do you understand? Right? So we have 89,500 divided by what? 12. Right? So we have 745,8333. So we have the gross pay here 745,8333. I think that's 7,458,333. So accrued salaries and wages, that's for the net pay, right? What do you have? 594,70333, right? 594,70333. So we have what now? Pension administrators. So what's the pension? Pension here 7,160 per annum. 7160000 divided by 12, 596666. So we have 596666. Okay, approximately 7. So what's the tax paid? 10,975,000, right? 10,975,600 divided by 12, 91463. So we have Inland Revenue Service, or what we call pay as you earn. What do I have here? 914,633. That's it. So basically, this gives us what? The breakdown of the salaries and wages. So if you add these three, it should give you this. Otherwise, something is wrong, so we might have to check. Plus 596,667 plus 594,7033. Okay, so we're saying the net pay plus the pay as you earn plus the what pay as plus the what pension administration. So what do you have there? 745,833. So it's correct. Okay, so that's the journal for the what salary. But remember, this pension administrator is the what 8% of what the gross. What I'm saying is this pension administration here is the employee's contribution of the 8%. Okay, of the what of the gross emolument. Now the employer will also contribute now, which is 10%. So we're going to say salaries and wages again, which is 10% of the gross, right? So let's go. So 10% of the gross amount now. 0.1 times 89,500,000. Okay, divided by what 12 to get the monthly amount. So salaries and wages, we're going to have 745,833. We're going to say pension administrator again. 745,833. So this one is the one that the employer is contributing. Okay, this one here is the one that the employee contributed. So the employer is contributing 745,833. Okay, the employees are contributing 596,667. So that is the journal. So after the journal, they say we should what? Do the extended trial balance. So what do we do that one now? So I'm going to take this off, right? To do the extended trial balance. So that's like the revised trial balance after preparing, after what adjusting for, or after preparing the what? The payroll. So what do you have now? So let's call it now. Extended or revised trial balance, eh? You can call it revised trial balance. So there's nothing there. That's after adjusting. So what do we have there? We have sales. Sales is the first thing there. Sales is 162,690. 162,690. I guess is in the minus 162,690. Cost of sales. Cost of sales there 84,480. 84,480. What's the next thing there? Total running and admin expense. Total running and what? Admin expense. 41. What's the next one there? Lab. Okay, owner's equity. Owner's equity there 15 million. What's the next one there? Liabilities. Liabilities there 31,640. What's the next one? Investment income. 5020. 5020. What's the next one? Current assets. Current asset is 5370. What's the next one? Accumulated depreciation. What do we have? 10500. Non-current assets. What do we have? What do we have there? All right, we have 49 million. So what are the new items coming in? So from here now, salaries and wages is coming in. What do you have? This is what? 7,458,000. Okay. So we have 7,458,000. 333 divided by 1,000. I have salaries and wages is an expense. So we have 7,458 approximately. And we have the accrued salaries and wages. What do you have? 5,947,033. 5,947,033. That's 5,947. 5,947. Okay. So what do you have here? Pension administration. What do you have? Well, I'm not making a mistake. Accrued salaries and wages is 5,947. Okay. Then pension administration is 5,96667. 5,96667. Okay. That's 597 approximately. Okay. The next one is pay as you earn. Pay as you earn. The credit side. So we have what now? 9,14633 divided by 1,000 there. So we have 915 approximately. So the next one there, salaries and wages again. Salaries and wages again for the pension 745,833. 745,833 divided by 1,000. So that's 746 approximately. Next one up, pension fund administration. We have pension administration. We have 746. Okay, 746. So now we have included all the what? New items. So that gives us the neutral balance. So if you add up, okay, if you add up, you should have the debit side equaling the what? The credit side. So let's try adding up. I don't think that will be an issue anymore. I think you should know what it is. So let's just pick it up here. We say the total before the addition there is 224,850, right? So plus, what do you have here? 7,458. 7,458 plus 746. So what do I have? 233,054. So what do you have now? We do the same thing here. 224,850 plus 5,947 plus 597 plus 915 plus 746. You have 223,054 approximately. Okay, so that is the extended trial balance. It's quite a long class, but it's worth it. So what about our accumulated depreciation? We didn't even put that. We didn't put that. So I can see depreciation here. Accumulated depreciation there is 1,250. So we're going to have to add that. Okay. So let's add that somewhere here. So we're going to say depreciation now. What they are there? 1,250. So we have 1,250. Then accumulated depreciation, this one will increase by what? 1,250. So if you add everything, you can definitely what? Agree. Okay, so let's add. So we have 224, 850. That's about the total before the new addition. So we can have all this here plus 7458 plus 746 plus 1250. So we have 234 314. So this will be the same thing. If you add everything here. So that is what we call extended trial, revised trial balance. Trial balance before the adjustment and trial balance after the adjustment. So before the adjustment is what the question is given to, but after the adjustments, this is what we have. So from this now we prepare the income statement. I think it's a very straightforward one. Let's see what we should take off. I think we should take off this, right?
Yeah.
So let's take off this. So we have what? Income statement for the month of what? March 2019. So what do we have here? So we have our notes, right? So the first thing here is turnover. Okay, note 1. Where do we put that? Let's say note 1. What make up our turnover is just sales. Okay? So note 1 here we have what? Sales. Sales is at what? 162,690. So we have 162,690. Okay, so that's the sales. So what's the next one there? Okay, cost of sales, note 2. So we have excuse me. Cost of sales, note 2. So let's call this note 2. Cost of sales. What's the cost of sales in the question? I think we have that 84480. 84480. So we have 84480. So if you take that out, what do you have? 162,690 minus 84480. So I have 78210. So this is your what? Your gross income. So what do you have? Other income now. Note 3. So let's say note 3 here. What's other income in the question? I think I can only see what? Investment income. So we have investment income. What's there? 5020. So we have 5020. So let's add up. plus 5020. We have 83230. So let's call this gross profit, and this is your gross what? Income. So let's go. Total admin and what? Running expense. Let's call that note 4. So we have note 4. So what are we have total running and admin expense here, right? Total running and admin expense. What do you have? 41 million. That's 41,000. So what else is current assets? Salaries and wages, 7458. Right? That will be 7458. So another salary and wages is 746. So we have salaries and wages. That will be 7458. 7458 plus 746. That's 8204. What other expense do we have there? Depreciation. Depreciation is what? 1250. Any other expense? There's none. So let's add up. 8204 plus 1250 plus 41,000. We have 5454. 5454. So when you take that out, and with minus what? 83230. What you have? 32776. This will be your what? Profit for the year, right? As I said, your loss is when your what? Expense is higher than your what? Your income. So from here you can see that the income is higher than the what? Expense. We have net profit. So basically, this I know it's quite a long class, but it's worth it. So what we've done here is to, learn how to prepare payroll. Okay, giving some basic what conditions, and then learn how to compute the personal income tax. Okay, basically, and then we also learned how to pass our journals to account for what? Payroll cost. Okay, and then we learned how to prepare an extended trial balance or a revised trial balance after the adjustments, and then we're able to use it to prepare our income statement. Okay, so this is basically a combination of these various things: payroll accounting, and then income statement. We're also able to touch some tax issues there. There's no way you can calculate payroll without referring to what your tax schedules. Okay, so if you have questions, you can reach me on the numbers displayed, or drop questions in the comment section. I'm there to reply with the right answers. And then don't forget that you can sponsor copies of my textbook that will distribute for students for free, or you can support us by paying to the account displayed. Thank you. Remember, you can take full classes on jarosconsulting.com, okay, and they are all free. Nobody's taking money from you. Just click on the category that's Financial Accounting, take your classes, then you can solve questions, examination questions, industry-based questions. And then the numbers displayed is both for WhatsApp and call. So you can call to seek clarification, or you can chat me on WhatsApp. Okay, another thing you can do is to add up, and then somehow let us know that you added up, so we can have you saved as well on our contact list, so you can see our updates. We do a 30-second topical updates on daily basis, so you can just learn a thing or two by following us on WhatsApp. Okay, so that's about it for now. Thank you.